I'm Joey. I'm from Pantera Capital. Joined recently. Before, just been doing venture previously at IOSG, and I look at a lot of infra and DeFi investments here.
Hey everyone, I'm Michael, co-founder and CEO of Zero G, and also the exec chairman of ZeroStack, Nasdaq listed DAT. Before I worked at Microsoft, Bain, Bridgewater Associates, and started a Y Combinator-backed unicorn company before Zero G. And at Zero G, we were building the blockchain for AI agents, or in other words, also a trust layer for AI.
Hi, I'm Helena. I am building ICME. We are a stock exchange for pre-IPO equities, and prior to this, I was an undergrad at Stanford.
Right on time, I guess. Hi, I'm Wojtek, the founder of Accountable. At its core, Accountable enables institutions to prove what they are doing off-chain and on-chain in real time and protecting their secret sauce. And on top of that, we also have the Vault infrastructure where they can basically build their tokenized financial products that people can verify and trust.
Okay, cool. Yeah, and I think Kyle couldn't make it, but I guess out of this crowd, we're all at pretty different levels on the stack, right? On the institutional stack. So curious from each of your perspectives, what does interoperability, compliance, and reporting all mean in this context, and why is it even important to begin with?
I guess I can start from an AI agent standpoint. Do you want to give your AI agent your private keys and access to your entire wallet and all of your assets today? Probably not. So that's basically the answer there. So you need to have a risk and safety framework in place in order for that to actually even be a thought where you feel very comfortable. And that can be in the form of, I approve every transactions of my agent, which once agents are a lot smarter and they will give you 1,000 transactions to approve, that becomes super tedious. So how can you put some type of rules or some type of safety guardrails in place where you don't have to do that and you can just completely rely on your agent to deliver a specific return for you over time without destroying your portfolio or stealing from you and still being owned by you. So all of these different elements need to exist from an agentic commerce perspective. And we're slowly getting there. There are certain standards in place like X42, which is basically the payment infrastructure. There's another proposal, ERC 813 something, I forgot, where it's much more of, now that I can do payments, how can I actually program payments in such a way that I can do subscriptions or other types of more complex payments to do those types of aspects. There's ERC 7857, which Zero G created, which is an ownership standard, where basically we embed the private keys into the metadata of an agent. And if you hold that token in your wallet, then you can 100% say, I own this agent now. And not only that, if that agent owns another agent token, it can then say, I own this other agent. And so it creates a lot of possibilities in this space. So that's a quick answer from an agentic standpoint.
Yeah, for us, our niche is probably on the compliance aspect. We've been very, regulatory first with this company. I think that there's a variety of companies in the pre-IPO equity space, and they take different pathways. Some are going to start offshore and always be offshore. Others are going to, try to become legal in the US. For us, we are taking the latter approach. And so a lot of what we do is, meet with the SEC, share our proposals, and take advantage of the innovation exemption program that was passed August 2025, I believe. And with compliance first, I do think we can truly have tokens that are backed by equity that give real ownership rights rather than just mirror some kind of value.
And I will tackle, I guess, from the reporting perspective. I think this became basically mandatory if you're thinking about tokenization. People are no longer relying on black boxes and situations like with stream finance, last year definitely accelerated that. So we give these projects that are going to the market means to prove that they actually have the underlying reserves and they're following the mandate of why these LPs are giving them money in the first place, working actively with many curators for ongoing underwriting of these opportunities, such that if they accept it as collateral on Morpho, right, they know what this token actually represents, because majority of these opportunities actually are being generated off-chain, right? Like just because the token is on-chain, that doesn't mean that the strategy is transparent. Actually, quite the opposite. We are packing into these tokens absolutely everything from gold trades to basically unregulated hedge fund activity, and then people call it a yield-bearing stablecoin. That I think it's highly misleading. So we try to give them means to prove that they are worth your money.
I don't think we can call it a stable coin anymore, right? That's like the compliant. You have to call it money, like magic money, right? But
Long basis trade.
yeah. But I guess like I think what you said about the SEC part was pretty interesting. Like what do you see from what the SEC is looking for specifically in terms of being compliant within crypto? Is it kind of different flavors with like depending on what you're building, or is it more like a generalized, oh, we want to see XYZ to give you some sort of compliance?
Yeah.
Go ahead.
Well, Paul very publicly, there's that line that has been blasted everywhere that he wants everything to be tokenized within the next 2 years. And I know he talks a lot about the super app too, where everything can be traded on the super app, from like equities to commodities to whatnot. I would say from our experience, the SEC is looking to innovate, and back in the day they had pilot programs to test out like an idea and see intended and unintended consequences before they wrote into rulemaking. So how we work with them is like take something they already know, introduce a portion of crypto that could be more innovative for the standard. This, like, for example, like for us it would be like settlement, like how can we improve settlement with crypto, and we take that and try to change the existing rules to be more innovative, so it's like something they know, something new, and then it's something they can swallow for a potential pilot. But generally, like probably the best regulation we've had that is very crypto friendly.
And for Michael, it's also kind of like a different approach, right? Like you're more spearheading the infra layer. What does your synergy or your interaction with like policymakers and compliance kind of look like for any builders that are trying to build an infra and trying to communicate what you're trying to do to the government?
It'll matter mostly at 2 layers. One is once we introduce privacy, so we invested in a company called American Fortress, for example, many patents filed in ZK, completely private transactions without needing to use a mixer. Everybody effectively gets a name. We can see each other's transactions that we send to each other, but nobody else can see our transactions. Now, if a regulator then says like, well, I suspect something nefarious is going on, maybe one of these people is on the OFAC list, can I subpoena them? And then the answer is yes, you can actually do that. And so it can be regulatory compliant from that perspective. So it'll matter at the transaction level to ensure that there's no negative kind of state actors coming in.
I want to push back because I know that a lot of people have been looking at privacy as kind of like a narrative play after like the whole Zcash, Monero token going up only kind of thing. But I'm kind of curious, what is like the actual use case for privacy? There's like a weird balance between like, well, I mean, like think about it. If you're too private, then you get like something like Tornado Cash and like DPRK, where you can't really like actually, like apprehend or have any accountability for the transactions you do. But then, on the other side, you can't be like selling your transaction data like Visa does, right?
Well, Tornado Cash is a mixer, and so this does not rely on mixing. So it basically does not obfuscate all transactions. Is this off? Test it. Okay. Never a good crypto conference without a mic failure. So, so yeah, basically what I was saying is Tornado Cash is a mixer, and so this does not rely on mixing. So you can still see individual transactions and so on, but you can't see balances, for example. So if you're two competitors and you put everything on chain, and then you can see your entire strategy effectively on chain through the transactions, that's something you want to prevent, then great. Or for example, if you're starting to use your crypto as your payment methodology and you don't want to see, have other people see that you're invested in like 20 meme coins, for example, that's another way to shield those types of things. So there's many different aspects where privacy can matter. Or for specific sensitive medical payments, for example, where you don't want people to know like, oh, I have this particular medical history and I just paid for this thing, then there's many aspects where privacy actually matters.
So do you think like the privacy aspect comes in only like, so the government should be able to see what you're doing on chain and what you're selling and what you're buying so that you can report it on taxes in a compliant way, for example, but other people shouldn't be able to? Because that's like also a big problem.
Yeah, I think it's only when you're doing something illegal and the government needs to protect kind of the rest of the population from it, or if you have a kind of state actor like North Korea doing a lot of state hacks, for example, and then funding its nuclear power program as a result of it, we probably don't want to condone behavior like that. So there should be a way to subpoena or figure out what's behind these transactions. And then beyond privacy, I think there's another layer around safety, and that hasn't been too much of an issue yet in AI, but you're starting to see some aspects of it. Models trying to replicate themselves, models leading people to kill themselves, literally, models deleting entire databases already. And so as these types of safety issues become more commonplace, then there also needs to be a regulatory framework in place for that, or some type of AI safety layer. And so that's some of the things that we're thinking about and building. Like we published a paper recently called Sparse Inference Time Alignment, which basically is a way of steering models away from high-risk behavior. So we analyze on a token-based behavior. When the tokens themselves display high risk or high hallucinations, we steer the model into a different direction.
Yeah, and I guess in terms of what institutions are asking for, like how do you think the ask differentiates from maybe like 18 months ago to now, whether it's privacy or compliance? What kind of stack they might find useful now versus before?
For institutions specifically, they also care about privacy of their data, not just of transactions. And so, for example, with inference, if you're an enterprise and you're like, oh, I have all this really valuable customer data, and when I use OpenAI for inference, I'm giving all this useful customer data to OpenAI to basically extract value from. And so you need a layer of privacy in order to do that. And you can do that through TEs, which is what we use on our private computer offering. And so that need didn't exist 18 months ago because institutions weren't even getting familiar with AI at that point.
I think again, like people were used to dealing with basically black boxes, and everybody was taking the yields in crypto for granted and focusing only on optimizing the underlying APY and not asking where is it coming from. Many people were seeing advantage in basically advertising their offering to show more. But now, again, as was mentioning, especially after stream finance and all of these situations that happened recently, it became sort of mandatory if you want to tokenize your product and raise money from investors, get the curation going to operate such a system and prove yourself. So that wasn't a thing 18 months ago. Back in the days, we are calling all of this unsecured lending, which is arguably safer than, because at least you get a master loan agreement with these parties, and with these unregulated hedge funds, you get terms and conditions where they tell you that if they lose your money, then that's fine. If they make some money, that's also fine. So I think people woke up in the last 18 months that it's not anymore fun and games. Aave was another great example of that. You realize that you're maybe risking your life savings being in the safest DeFi protocol, as many people said. So it's all about, at the moment, proving that you're worth somebody else's money, and any tool that can help with that is the winner here.
Yeah, agree with all of the above. I do have, back and forth opinions on privacy. I think, just like, shower thoughts, I think privacy products can be quite lucrative. One random one that I think would be cool to share is like, if you had agents trading prediction markets, but you run simulations with these agents and they're, trained with population data or like receipt data from Walmart or something. And you have these agents do predictions that you then sell to institutions. I think that could be really interesting, and you'd want that to be private in order to monetize. But then, I got into crypto, and the people I work with got into crypto by like studying SoulScan, and like we appreciate the beauty of like being able to track how traders trade and like what's going on behind the scenes. And it's so easy for us to detect a bad actor when there is one, and a good actor when there is one as well. And so it would be sad to see all of that go away, I would say. Yeah.
I kind of want to push back on the institutional DeFi stack part, right? There's kind of two sides to it. There's one is like institutions who they're touching like these RWA pointed products like Ondo or Centrifuge or whatnot. But then there's the other side, which is like retail DeFi users who are willing to take, like the risk for the 4,500% APY that we used to get in 2021 from like Beanstalk, right? It's like a same analogy as buying S&P or buying meme coins to an extent.
But retail is gone, so you don't need to worry about it.
Okay, that's fair. I know we're like a little bit short for time, but I'd like it if all the panelists could give like one maybe contrarian opinion they have about this space or just in crypto in general. Another shower thought.
Yeah. Well, I think, the regulators are great. Like, I think regulation is a good thing. I know it's been not so much when crypto was first becoming a thing, but yeah, like we just love the regulators.
I was going to say, don't trade crypto in the shower. No, but I would just say safety for AI is underrated at the moment. I mean, a lot of people think about like potential visions of what can happen if it goes wrong, but there's not a lot of action put behind it. And so I think crypto has an answer by becoming a truth layer for AI.
I would say that the less DeFi in DeFi, the better, actually. And the true opportunity lays off-chain, and we need to do everything possible to bring them on-chain. And the next solutions that will take over the world will be around qualified custody and not moving money from Morpho to Aave and calling it a strategy where you create basically huge honeypots of money that people will be always inclined to take from you. So let's start looking beyond the on-chain world and bring what's good about it to the actual chain. Operates through vaults, but the less DeFi, the better, it seems.
Okay, well, thank you to our panelists. I guess, I don't know if we have time for questions, but maybe we can end it here.